Hey everyone, it's Dale Anderson. Hope you're well. I just wanted to give you a quick update on the latest market news and what's going on. We're going to talk about today property market data, credit card data, car finance, mortgage and new build data, how this is affecting or potentially going to affect the property market. So a lot of people are talking about a potential property crash or prices are going to crash. So what's been happening is the Bank of England is warning that a proportion of households are struggling to pay their mortgages. Mortgage rates could rise to levels not seen since 2008. So I've actually been in property investment now for almost 20 years. So I was involved in the property market during the recession of 2008, 2009. And yeah, there were a lot of opportunities that came about, but naturally right now everyone is concerned. The property market is on the verge of a potential correction and the stock market is poised to fall even further as the cost of living crisis worsens. As we've seen Liz Truss, shortest living PM, so there seems to be a lot of political uncertainty. Obviously Rishi Sunak has now been appointed, so we'll see how he does, but we don't quite know until the budget's announced on the 30th of October, end of this month, really where things are going to be heading. So at the moment what we have is a continued increased interest rates. I mean, this is seems to be happening across the world. There seems to be inflation, energy costs, interest rates are going up. So what is this going to do, and how is this going to affect the UK property market is a question which seems to be coming up quite often, regularly. So first thing we'll cover is credit cards. So credit cards are great to help to build wealth. People have started businesses with it, but people who are responsible don't understand how to manage credit. You can run into debt and trouble as well. So according to the Office of National Statistics, 1/5 of Britons are now being forced to borrow more money to meet payments. Half are unable to save anything, according to the ONS. In 2 weeks, run up to the September 25th, 2022, 20% of the UK are reporting to having to borrow more money or take out credit. The Office of National Statistics findings correlate with the Bank of England, who said borrowing has increased at its fastest pace in 17 years. The biggest increase is the ages of 30 to 49 and also 16 to 29-year-old category. To make things worse, 1/3 of the UK population reports that they are unable to afford an unexpected expense of £850, for example, on new appliances or increased household bills. So 18.2 million households have had to cut back on essentials such as grocery and home appliances. The Office of National Statistics are also saying that there is a potential energy crisis. I mean, prices have gone up, as we know, by about 20%. 2/3 of Brits are reducing spend on essentials such as gas and electricity, as well as groceries. So despite the government introducing a support package recently which capped household energy bills by £2,500 per year, a large portion of the population are struggling to repay. So mortgage rates have skyrocketed. I think they're reviewing the base rate again. New build purchases are plummeting. I mean, this is largely because new build costs with inflation have gone up, making new build very difficult for developers to get the right value and get the costing right. So not only is it affecting individuals, but businesses as well. In fact, Santander, which is the 4th largest bank in the UK, are now increasing their standard variable rate to 0.25%, so to 6.24% from the start of November is your 2-year fixed rate mortgage, and an interest rate of 6.04%. So Mike Rayner, CEO of Santander, said we have seen a slight increase, but not yet a significant increase of customers falling behind on payments just yet. So Santander have 11% of the UK mortgage markets, which is huge. They've got a book of 184 billion of home loans as of July. It's put aside £66 million for potential defaults in the second quarter. So the real concern there is the Bank of England have recently said they're going to stop with their support package. And what this means is your gilt markets, pension markets are fairly unstable now, and they may not have that buffer of support in the event we do go into a financial crisis. On top of that, big developers such as Barratt Homes are warning of a weakening demand, with new build reservations dropping by a third from 281 per week within the last financial year to 181 per week now, recently, reporting a less certain outlook on the new build housing market. Plus inflation, 10% inflation of build costs hasn't helped. That will effectively be passed on to buyers' prices in future potentially as well, which will increase the cost of homes. So next we're going to discuss car finance, because this also impacts people. Finance after cost is growing exponentially over 10 to 15 years. The average amount borrowed on new cars has more than doubled from £11,964 to £25,039 between 2009 and 2022. Similar average amounts borrowed on a used car has increased by 87% over the same period, from £8,440 to £5,771. £15,771. So to put this into context, the average weekly earnings have only increased by 30% over the same period, showing how much people have leveraged and borrowed, because effectively what's happened is we've been, since Brexit and COVID and everything else, the banks have kept interest rates super low. I mean, we've had record low borrowing rates in the UK. In fact, other parts of the world like South Africa and places like that, they already pay sort of 9-10% interest, so they're used to it. But in the UK, we've become very comfortable with very cheap borrowing for a while, and it was bound to happen that interest rates would effectively start to go up, especially now with inflation as well. And so next, let's go on to the pound. So the pound has dropped recently quite sharply since government borrowing has reached its highest level since the financial crisis. After Andrew Bailey, the governor of Bank of England, warned of emergency support package for markets would end 2 weeks ago. That was about 4 weeks ago. So Bailey announcement has created uncertainty, and what will follow once the support package is withdrawn is the concern. Financial analysts predict gilt prices will be on a roller coaster. Pension funds, as I mentioned, relied on liability, have not been able to shore up their position, and gilt yields will rise. There could be another fire sale causing the pound to fall further. Hopefully the pound has been resilient in the past, and provided the politicians get it right, this may not happen. But in the unlikely event, the government will have to gain the comms of the market by then, as it's not due to present its plans drafted by the Office of Budget Responsibility for balancing the public finances until the 31st of October. So until then, we're in a bit of a sort of grey space of uncertainty. So what does this mean ultimately for property? It doesn't look great. I expect there will be a small fall. Originally, when COVID happened, the Bank of England said prices would drop 15%. They haven't, because demand and supply and borrowing rates were still low. Plus, they had the stamp duty holiday. So this kept the fuel going, it kept the market going, and it kept prices going up. People were also changing their demands of what type of housing they wanted during COVID, and people were borrowing and capitalizing. However, prices had gone up during that period quite significantly. So we probably were or are in need of some sort of a property correction, but how big that fall or correction will be, we're not quite sure. I was thinking 5%, I'm thinking now probably likely more 10%. But what this does mean is there's also going to be a lot of motivated sellers in the market looking to offload their assets and ultimately sell their properties, possibly for a slightly cheaper price. So definitely, if you are holding on to cash, it could be a good time, because currency is devaluing. The bank's printing more money, which means more quantitative easing, which means your money in the bank's maybe not as stable or even safe as it has been in the past. So things aren't looking great because of inflation and dramatic interest rates increases. People need to know what they can and cannot afford. If you own a property and you are earning a single income, you'd really want to look at how the interest rates are going to affect your repayments and if you can afford it. So any buy-to-let investments we do, we still make sure that they are going to be cash flow positive. It's going to become harder to find the right deal for investors, but we're always on the lookout for good deals and motivated sellers in this type of market which we're heading into will be a buyer's market. So of course we've got winter energy bills coming up, the property market correction or crash. Let's see what happens. Nobody can really look into that crystal ball and tell. However, it is a good time to reassess your portfolio. We'd recommend speaking to a mortgage broker, making sure you've got the necessary resources in place, and in the future make sure that you do diversify your portfolio. Look at income generating assets that will give you cash flow positive yield. So even if you've got to hang tight for 1, 2, 3 years, it's not going to be a massive issue because your debt or your repayments you can afford to cover, or your tenant will be paying. So that's my advice, and yeah, that's the latest news. I'll be keeping you up to date, and yeah, if you like the video and you found this informative, please click and like the YouTube channel. Please subscribe, please share. As I grow this channel, I'll keep sharing content. I hope you found this useful. Take care, have a great day.